Thank you very much for the invitation. And I was just noticing with all the lawyers in the room here that I just wanted to make just one lawyer introduction. So I have been responsible for doing the Novo Nordisk annual report for a number of years. And in one particular year, I recall that we were going to run an article about a new product that was about to be launched. And our corporate lawyers were going through the manuscript, and they returned it with all the red, overliner. And there was virtually nothing left that I could communicate to my stakeholders. And I said, but this is a very difficult situation because we have these 2 pages, we have this spread prepared, and what do you want me to do? And then we talked about what we could include, and I said, well, we could talk about such and such, but that would be a little bit of fluff. And to that, my corporate lawyer answered, well, we love the fluff. So I think on that note, let me just start by talking a little bit about Novo Nordisk. And I will not really give you a lot of details about how much revenue, how many people, etc., because I take the liberty of presuming that you have a general idea about what the company is about. And what you really want to hear in this context is how we work with purpose. So very, very briefly, Novo Nordisk is a company that is dedicated to work in the field of providing treatment for chronic disease, predominantly diabetes, hemophilia, and growth disorders. So that's the line of business we're talking. We're based in Denmark, outside of Copenhagen. We are a global company. And we are by now the 8th largest pharmaceutical company in the world. And just one more information about size is that in terms of market cap, which we have discussed here today, we are now the largest company in Scandinavia, outperforming Stakeholder that used to be the largest. So many people are asking us, when we talk about the company, so what is the secret sauce? How can you be a successful company that is responsible and profitable at the same time, that has been in business for 90 years, and I just learned this morning that that is way beyond the average age for or lifetime for a company on the top lists. And just like many other companies, many other products, there has to be a secret ingredient. Coca-Cola has its secret recipe. I'm a great fan of French wines, and all French wine makers would say it's terroir that defines the quality. And so my answer to what's the secret sauce of Novo Nordisk is there really is no secret. We have 3 main ingredients. So when we make our products, when we make insulin, we use 3 ingredients. We use water, we use yeast and sugar, and then basically there's a fermentation process, and out of that comes the product. A great, unique product that has given us a market-leading position in the space of diabetes. So let me use that analogy and then talk about the 3 ingredients that are relevant for this conference. So the first one is purpose. So that's the sugar. And the company was formed by an entrepreneur more than 90 years ago, a professor whose wife had diabetes and who led him to seek out some professors who understood about what could be done to treat diabetes. And he brought it home, the recipe, with a condition. And the condition was you can go back and produce and sell it, but you have to make it available to people who need it. So there's your purpose. So what we have now included in our bylaws, in the Articles of Association, is that the company is about discovering and developing innovative biological medicines and making them available to people who need it. What is also a secret ingredient, which is not so secret because it's stated publicly, is that we have included a direct reference to what we call the triple bottom line business principle, that we seek to do business in a way that is financially, environmentally, and socially responsible. So that's a very clear signal to investors, to people who want to work with the company, to people who want to partner with the company, to all our stakeholders, that this is how we do business. So that's one. The second one, the yeast, is the values. So we really believe that in order for our companies to be successful, we rely on a healthy society with healthy people and a healthy economy. So that interdependence that we also heard before is very well known with the company. And it really derives from the integrity, the personal leadership of the founders and all through generations of leaders in the company. There's a very strong sense of understanding of the stakeholder, respect for the stakeholders' interests, and that we really focus on saying it's not so much what you achieve, it's how you achieve it. The third ingredient, the water you may say, is the governance. And the governance consists of various elements. The first one, the most important one, is that the company has a very unique ownership structure. So when it was a family-run business, the owners decided to set up a foundation. And this foundation now controls ownership of the company. It owns about a quarter of the share, but it controls about 70% of the shares. And this is achieved via a dual share structure, where we have A shares and B shares. This is not unique in Denmark, I should say, but the A shares have 10 votes, where a B share has one vote each. So the B shares are listed in Copenhagen and New York Stock Exchange, and the A shares are not listed. So having this ownership means that we have a very strong commitment to stay true to the values, to the company, to the purpose of the company, and that the foundation cannot divest its shares from the company. So that way around, it's a checks and balances. We keep each other accountable. There's a lot more to be said about that. We can talk about remuneration, we can talk about integrated management, integrated reporting, governance structures, etc. We can come back to that. By way of analogy to what we've discussed previously, I could say that our, what is so-called the clean capitalism pay-link is 22 to 1. So our CEO gets 22 times as much in salary as the average employee in Novo, which I believe is quite attractive compared to many other companies, actually. So if I then get to the secret, then the secret is really the people. So I think it's important to remind ourselves that we've talked about companies and corporations. Companies don't make decisions. People do. People don't trust companies. People trust people. People don't want to work for companies. They want to work with people. And so if there's any secret to the way we run our business, it is in the way that we select and groom and develop the people so that they can make the right decisions. And then let's just conclude by talking a little bit about the outcome, because we've used the word MSV on many occasions today. And you know, in politics, and since we are in Parliament, I thought we could just adopt some of the techniques here. In politics, the way you can get ownership to an agenda is simply to steal it from your opponents. And I actually want to suggest that what we can do with the MSV is to steal that notion and then begin to talk about maximizing share value or maximizing sustainable value, because that really is what we've been talking about all day. And then the conversation becomes a little bit more interesting. So as a very final remark, we heard quotes about John Elkington earlier today. What we find is that this approach, it has been seen by our peers, by companies, by stakeholders who look at us as a competitive asset. And we actually do a lot to be able to demonstrate the shared value provision. But John Elkington once said in a conversation, you say it's a competitive asset. I actually wish it weren't. So let me leave you with that, and let's hear the other two interventions.
Thank you for inviting me to speak today on behalf of Calvert Investments. Please allow me to express my real gratitude to the hosts of this event, to Frank Bold, Richard Howitt, and the Cardiff Business School, as well as to organizers Chris Halberd and Philip Greger. Let me add that Richard Howitt has been a persistent and influential leader on behalf of corporate responsibility for 15 years now in the UK and across the EU, and its mainstreaming here and across the Atlantic and around the world owes him a significant debt. The time has indeed come to reassess and in some ways to redefine the purpose of the corporation as this conference proposes. At Calvert, we have embraced and advanced a broader view of that purpose, certainly including but not limited to shareholder value, for over 3 decades as we have evolved into the largest family of U.S. mutual funds, spearheading what we used to call socially responsible investments, and we now refer to as sustainable and responsible investment. Our success both in generating competitive returns for our investors and in influencing hundreds of companies to become more sustainable and responsible tells us that we do not have to choose between shareholder value and societal benefit, that we can and we should combine the two approaches on a much broader scale that can achieve a much deeper impact. While our investment philosophy at Calvert will always focus on maximizing returns for our shareholders, it will also remain instilled with the deeper purpose of identifying and further improving corporations to act as responsible citizens and promoting a more sustainable world. From the vantage point of over 3 decades delivering on that dual proposition, we observe 2 sets of trends that make us optimistic that the world is now moving in our direction. First, we see a positive shift in the mindset of investors. While we once attracted investors who were mainly interested in aligning their personal values with their investments, we now attract investors who understand that this alignment can maximize their returns as well as contribute to a better world. These investors care about the size of their retirement portfolios and the kind of world that their children and grandchildren will inherit. They care about both, though, not just one or the other, because they want to be financially comfortable and socially responsible at the same time. And we at Calvert believe, and our investors have come to recognize, that our ability to incorporate and integrate environmental, social, and governance factors into our financial analysis of companies allows us to avoid certain companies and to invest in others that present the best prospects for long-term success in a 21st century world in which those factors are increasingly salient and indeed in many instances material. At the same time, we see more traditional mainstream institutional asset managers and pension funds acknowledging the importance of these ESG factors as vital sources of risk and opportunity that can and do affect long-term and sometimes short-term performance of companies. That wider angle lens view of the world will increasingly drive investment in the 21st century and allow investment managers to look over horizons and to see around corners that were not visible or discernible to most as recently as a decade ago. Second, we see more companies across just about every industry and geography embrace at least the language, if not always the substance, of corporate responsibility and sustainability. More companies recognize that responsibility is hardly limited to philanthropy, however useful and laudable, and that the most serious contribution they can make is to find points of alignment between shareholder value and societal benefit by connecting their business strategies to sustainability challenges that also present opportunities to deliver new products and services to old or new markets and customers. These companies recognize the challenges and seek to seize the opportunities associated with the steady march toward a more sustainable world. From addressing climate change and water scarcity, to fighting disease and hunger, to ensuring digital access and freedom, to educating and empowering women and girls, to alleviating poverty and generating more equitable, sustainable growth. We at Calvert believe that the success of the corporations in which we invest will depend in part on their willingness and their ability to see risk and especially opportunity in these terms, and not only in the advanced economies, but also in the emerging and frontier markets which are moving front and center into the global economy. At the same time, we believe in the primary role of governments, not just markets and companies, to address these challenges where they have the greatest legitimacy and capacity to do so, whether on their own or together with business, NGOs, and civil society. But still too few companies see the incentives to take such a longer-term strategic view of their sources of competitive advantage and indeed their corporate purpose. Most major multinational corporations continue to prioritize the maximization of short-term value at the expense of investing in long-term sustainable outcomes. For example, in 2010, the Fortune 500 companies had $700 billion in profits from $10.7 trillion in revenue, generating an overall 6.5% return on investment. These corporations returned very little of these earnings into long-term research and development, and instead spent much of these earnings on short-term buybacks and dividend distribution, sometimes appropriately and even necessarily, but too often lacking a longer-term lens of shareholder value, let alone societal benefit. Today, we welcome the debate around how we define and measure shareholder value as paramount to the purpose of ensuring sustainable outcomes. Professor Lynn Stout of Cornell University Law School recently wrote in her book, The Shareholder Value Myth, about the concerns of solely relying upon maximizing shareholder values. In her words, quote, shareholder value thinking causes corporate managers to focus myopically on short-term earnings reports at the expense of long-term performance, which causes companies to indulge in reckless, sociopathic, and socially irresponsible behaviors. While we at Calvert do not think that such indulgence is always the case, and we certainly believe that there are a number of companies which nonetheless manage to operate within that dominant paradigm and yet generate both longer-term shareholder value and societal benefit, that they are too few and that the incentives for them to take the longer view are insufficiently tangible. That dominant paradigm, though, is beginning to be challenged, even and perhaps even most significantly from some who have been among its greatest protagonists and practitioners. One such apparent convert is Jack Welch, the former CEO of GE, for whom I worked early in my career from the mid-'80s to the early '90s. Jack made GE into one of the most profitable companies in the world by increasing profits 600% with 100 consecutive quarters of increased earnings, and not only embodied but articulated the primacy of shareholder value, beginning with a famous speech he gave shortly after becoming CEO in 1981. But more recently, and without at all regretting that remarkable track record, he now emphasizes that a sole focus on short-term profits is a mistake that companies cannot afford to make, and that profits must be allied with efforts to increase the long-term value of a company to ensure sustainable success. In his characteristically pungent language, he recently told the FT that, quote, on the face of it, shareholder value is the dumbest idea in the world. Shareholder value is a result, not a strategy. Your main constituencies are your employees, your customers, and your products. Well, Jack certainly gets it now, and salute him for it. His successor, though, Jeff Immelt, walks the walk on behalf of GE in connecting greater societal benefit to shareholder value. At a speech he gave at the height of the recession in 2009, he said that the job of business leaders is to build competitive companies that over the long term in every corner of the world can succeed by shaking off that short-term mindset that brought on so many problems. Those words are consistent with GE's actions, especially with Eco-Imagination, the company's environmental and sustainability-focused R&D and business platform. Initially dismissed by some naysayers as little more than a brand marketing platform, GE's products and services marketed under the Eco-Imagination banner have generated $100 billion in revenue over the last 8 years, while making the company a global leader in renewable energy and helping the world in its urgent quest to curb greenhouse gas emissions and curtail climate change. Another corporate leader besides Jack Welch, or now Jeff Immelt of GE, willing to break away from that still dominant paradigm is Paul Pullman, the CEO of Unilever, with whom I'll have the privilege to meet tomorrow here in Washington, D.C. He recently wrote that, and I quote, that the short-termism of so much modern business, quarterly capitalism, lies at the heart of many of today's problems. I agree and have said so many times, occasionally to my cost, he said. At Unilever, words have been backed with action. We've aligned management incentives for the long term and invested heavily in R&D to build our pipeline of innovations. In addition, we've moved away from quarterly profit reporting, Pullman said. Under his leadership, Unilever's also made a 10-year commitment to what it calls sustainable growth across its value chain, with the goals of improving nutrition and health, reducing environmental impacts, and diminishing poverty in the many countries around the world where it markets and sources its products. Unilever and GE are leading by example, but we need many more such companies to step forward, many more such CEOs to speak out. We need many more to demonstrate that shareholder value, especially if recast along a longer-term horizon, can and must generate societal benefit as well as financial concerns consistent with this broader corporate purpose in the 21st century. At the same time, the growing numbers of investors who share this view must step up our shareholder advocacy on public policy engagement to raise industry standards of environmental and social performance and to expand disclosure and reporting requirements. We have the credibility as investors to make the case that what we Americans call skin in the game, to point toward that more balanced, longer-term view of shareholder value and corporate purposes alike. So let us combine forces, maintain this focus, and I hope one day, after years of hard work and hard-fought victories, we can look back at this conference as a turning point when we crystallize the problem and together galvanized action. Thank you so much for the chance to address you today, and good luck in your deliberations. And we look forward at Calvert to joining forces with you. Thank you.
So thank Mr. Freeman by email. And now let's move to Pierre. Pierre, the last word, please.
Thank you. So, to employers, SI activists, time for the unions. An old tradition here, Brussels and European Union, that's one of the last remaining area where social partnership has still a meaning. I think we had a very refreshing morning discussion, also afternoon. Also, I tend to believe that academic experts are better to explain us the situation than practitioners, but I say it's refreshing because, especially for the constituency that I represent, so I work for unions, confederations, I'm accountable to national confederation from the OECD economies, the FRCIO, British TUC, Rengo in Japan, and so on. Why? Because unions need also to have a narrative on the license to operate of the company. Our job is to represent workers, to hit back at employers, to be tough, to engage, to bargain, but we also need a narrative. We need this vision thing to share. We need a story. And that story, this inspiration, we can only get it with the academic circle. So I really mean it when I say it was refreshing this morning, the writings of Lazanik and O'Sullivan in the 90s, of Margaret Blair and Dean Stout, of the late John Parkinson, passed who I think was in 2004, have been essential, really essential for my organization, the Trade Union Advisory Committee, in helping our affiliates build this vision, this narrative on what is the purpose of the company, what is its license. So I have 10 minutes less now, given the fact that I am French. I've tried to negotiate the exception culturelle. On the substance, we still obviously need to bridge the gap. Richard already mentioned, he still has this artificial gap between corporate governance and corporate social responsibility or responsible business conduct. We have this gap between the academic world and policy making that needs to be filled. And since we're in a closed forum, there are perhaps also some gaps within my the movement that's all been filled. Because when it comes to corporate governance reform, clearly not all trade unions will come in from the same angle. Let's say that we have complementary approaches between continental European unions, for which the main entry point into this discussion is worker participation, and Anglo-American unions, for which the main entry point is what is called workers' capital, the stewardship of workers' capital. Some who believe that they may be contradictory or in conflict, they are not, they are complementary. Worker participation is, as you know, the right for workers to be informed, consulted on the business plan of the company, and foreseeable risk factors. There are institutions for that. They are called Works Council, democratically elected, transparent Works Council, as well as board-level employee representatives who sit on the board, who themselves are democratically elected employee representatives, either elected by all workers, or they are appointed by the unions that has signed on the collective bargaining. This worker participation is not necessarily easy for trade union action. Trade unions, some trade unions, it doesn't necessarily flow easily. Also for us to be represented, because sometimes it can be seen as a potential to collective bargaining. Workers' capital strategy, as you know, is the idea that since unions have a duty to nominate trustees who sit on the board of pension funds, unions will then whisper at the ears of the member-nominated trustees and tell them, well, since you sit on the board, you may not necessarily have a majority, but you will do your best to try to negotiate with the asset managers, responsible business, responsible investment strategies. And sometimes this will also come in with more activist engagement, targeted at some companies. There are also, it's not necessarily an easy strategy because it was also mentioned. Pension funds is regulated by law, needs to has a diversified portfolio. We would love to have pension funds invest only in the real economy and to infrastructure, real projects. It happens that they are exposed to private pools of capital, including hedge funds. They are exposed to short-termists. And they are also sometimes in an investment change situation, means that they, as asset owners, are not necessarily in a good balance of power with the asset managers, who are supposed to be accountable. So that's basically how we see worker participation on the one hand, and workers' capital on the other. In the developing countries, unions will perhaps be less active on the discussion on corporate governance. However, on topics such as related party transaction, abusive related party transactions, so that's when the founder of a company uses the company resources to buy a Porsche to his son, to divert the resource. There, the issue we want to say to regulate, say, well, abusive related party transaction may indeed hit minority shareholders, but it happens also some other stakeholders, and so hence bring the discussion to stakeholder approach via this discussion. I have less than 5 or 4 minutes, I guess. So I'll just remind you that at the OECD discussion on the license, the discussion that we have today, let's hope, will perhaps gain greater visibility at the OECD because the OECD is about to launch a review of the principles of corporate governance, which were first drafted in '99. So that's a principle. It's a text of 52 pages long. 52. It was drafted after the Asian financial crisis. At the time, the idea would say, well, we, OECD, the rich country, industrialized country, we are going to give you the good lessons in Asia. We're going to tell you how to run a company, because we know how. Unfortunately, we saw afterwards that with Enron and with Parmalat as well. We speak a lot about Enron, but the same happened in Europe. It was actually not necessarily the OECD was not necessarily in position to get that. So the principle we revised again in 2004, and now they are at last 4 years into the crisis engaging a new revision. So you see that text are revised after a financial crisis. It will be another battle for labor. TUAC, as an official advisory body, will have privileged access, likewise our business counterpart, the Pierre. I can only hope that you in the room, that the academic world, but also NGOs, will take an active part into this process. It is a text that is indeed non-binding. It's like many OECD texts, but it is a text that will set the tone. Hopefully also for the European Commission. It set the tone, ironically, very often outside the OECD, because it is often used as a benchmark for the World Bank and the IMF when they go in developing countries, and sometimes arm twists governments when it comes to fiscal reform. So there is a window of opportunity for us all, I guess, to help shift and move away from a shareholder value-oriented model towards something more progressive, more stakeholder-friendly. I won't go into the details, but let me highlight perhaps just one example where precisely we could help bridge the gap between responsible business conduct and corporate governance. That's the corporate governance implications of the new UN guiding principles on business responsibility when it comes to human rights. Without going into details, these principles are embedded in the OECD guidelines for multinational enterprises, which, as you will know, is a responsible business conduct text, but which has a resolution mechanism that says that you can bring cases against individual companies for breach of those guidelines. Well, it happened that 2 minority shareholders of a Korean company, which obviously did not do too well when it comes to respecting those guidelines in Indonesia, have been are now involved into a procedure for failing to applying due diligence in the way it was engaging with that company. So the application, in a nutshell, the application of the UN of this UN framework means to the financial sector, among others, raises the issue of shareholders' responsibility to be active and responsible shareholders. When it comes to asset managers don't own the share, they hold them on behalf of asset owners. So anyway, it will still be an uphill battle, and I'll finish there. The OECD is a very conservative organization, but there will be several, I guess, round of consultation. The TUAC, trade unions, we will soon produce our first key advocacy program, which I will freely share with you. But again, sorry to insist, you may sound, okay, this is the OECD, it doesn't really matter, compared to other agenda. Please do not underestimate the impact of that upcoming review. Again, have the intangible impacts of this process.